Time now for our stock of the hour. We've been monitoring the regional bank stocks today after a key U.S. regulator painted a mixed picture on the sector's health. The FDIC describing the group as resilient in the second quarter after, of course, a very stressful start to the year, which included bank failures. At the same time, though, the FDIC noting there are still 43 banks on its so-called problem bank list, which has not changed, Matt, since the first quarter.
Yeah, very interesting. And we should note, though, that is a tiny fraction of the total number of banks in the U.S., which is numbers in the thousands. Stephen Biggar is Argus Research Director of Financial Institutions Research. Stephen, let me ask first about your confidence in this report. I mean, is the U.S. banking system still sound and resilient?
Yeah, hi, Matt. Well, yes, I think today's report card was, a bit of a relief for the banking industry. We did see that profitability was flat with the first quarter when you back out some of the accounting items for the failed banks, flat with the fourth quarter as well. That's not a bad outcome, considering all that the industry has been through. Some of the highlights, deposits were down for the fifth consecutive quarter. Probably no surprise there. Clients are very active in seeking out higher yielding alternatives to bank deposits. But at the same time, the trend there has actually moderated quite a bit. And we actually saw that massive inflow to large banks from small banks in terms of deposits had moderated as well. So I think, all in all, it was a decent report card for the bank industry. And as was mentioned, shows the resiliency.
So when you've got a situation where deposits are down and competition for funding is up, Stephen, how does that impact the bottom line performance for these regional banks going forward?
Right. Well, particularly for regionals, yeah, there's a bit of interest margin erosion that's taking place and will probably continue to take place as people find better alternatives, higher yielding alternatives for some of those deposits. So the banks are having to increase deposit rates a bit, as they said on the second quarter conference calls. So that's expected, but not in a huge way. And I think part of the reason is that, a lot of deposits that are in place at banks are very steady, very stable. They're there for, purposes of liquidity for people, for individuals. They don't go down to their last dollar and put it somewhere else. For banks, for commercial customers, they have bank covenants and so forth that they have to keep so much cash on hand. So I'm not ready to declare a bottom in terms of the deposit outflows here, but I think the moderation is a positive, and that bodes well for net interest margins to at least stop deteriorating at the same extent that they have these first couple quarters of the year.
Are we at a peak or a trough, depending on how you look at it, in terms of credit? I mean, has it gotten as tight as it's going to get, or do you think credit will continue to tighten?
Well, banks do face a conundrum with that, certainly. We've got a situation where loan growth demand has softened because of higher interest rates. That's natural. Anytime you raise the cost of a good, you might get less demand for it. So we certainly have that. Banks are, we'll say generally that they have not tightened credit standards with the exception of commercial real estate, where, clearly there's some trouble spots on the horizon there in terms of vacancies, in terms of refinancings. There's a lot of that coming due. So certainly on the commercial real estate front, and the office space in particular, they have pulled back credit. But credit card, auto loans, residential mortgages, to the extent that there is any demand for that, it doesn't appear that there's been much in the way of pulling, reining in credit availability.
That's what I was going to ask you about. I mean, at least with some of the Canadian banks recently, Stephen, as you know, they set aside a lot more money for potentially bad loans, just depending on where the economy goes from here. I mean, even with an area like auto delinquencies, we're not getting a sense that could be a trouble spot going forward?
Well, the two areas that worry me most would be auto loans and even more so than that, credit card lending, which, there was a lot of press when the credit card, the revolving amounts went over $1 trillion collectively in the U.S. So that's a lot. And, if you look at the household debt as a percentage of disposable income, it still seems manageable. But it is worrisome that people are putting that much on credit cards, and particularly given how high interest rates are for revolving debt on credit cards. So I think that yeah, there could be another shoe to drop there if the consumer weakens a bit here. If we get some backup in the unemployment level, there's a very hard correlation between unemployment and rising delinquencies. So if you have a job or can replace a job easily, you tend to stay current on your bills, and if you don't, you'll go delinquent. So that is a big concern, and credit cards is the first thing that people will stop paying on if they run into trouble. They need their car, but can do without it if need be. They will let that go. Housing obviously is the last the last one to be stopped for people to stop paying on. But so there are some worry spots, and I think bank stock prices are kind of inherently showing that those concerns.